Okay, you're good to go.
Excellent. Okay, take two. I'd like to call the meeting to order and seek approval of the minutes from February 9th, 2020 meeting. Any discussion or changes? If not, is there a motion to accept the minutes?
I motion to accept the minutes.
Is there a second?
Second.
All in favor?
Aye.
Aye. Opposed? Nope, passes unanimous. Is there any public comment? There's no public comment. We'll move on to approval of the pension applications. There's one application. Jerry, are you up there?
Yes, I am. Can everyone hear me?
Yes.
I believe, yes, we can.
Okay, so we have one application for a new pensioner, and we have one modification to an existing pensioner, which is Stanley Schuler, who has requested to designate his beneficiary, a different beneficiary than what was previously included with his prior application. So what he is doing now is asking for approval to name his spouse, Suprema, as the beneficiary. And under the terms of the pension plan document, any change to a beneficiary must be made in writing with the pension board. And so that's why this application or request is being presented to the board this evening.
Okay.
Is there any requirement that the prior beneficiary be notified?
No, there's nothing in the plan document that, there's no language, I should say, in the plan document that requires that.
Okay.
But you know what, actually, the beneficiary is probably not notified by the city anyways, is it? Are they?
They are not, no.
Okay. But why don't we first go over the pension application and then we'll go for the change of beneficiary?
Sounds good. We have one application this evening on behalf of Marvin Sanders, park maintainer with Recreation and Parks. He is 56 years old. He is requesting an early pension. He is elected option 1, and his monthly benefit would be $3,066.21 annualized to $36,794.52. And there is a small typo in there. There's a 0 where there should not be.
Is there any discussion on this? I looked it over. I thought it was fine. Is there a motion to accept the application?
Motion to
Hello out
accept the
there.
application.
Second.
Hey, Joe,
Yeah,
all in
Frank.
favor? Yeah, I just
Aye.
wanted you to say we're motion
What?
to accept the application.
I said that. Didn't I?
Okay, I didn't hear you. I apologize. I was
Motion
thinking
to-
you were stalling, so we would be on 8 o'clock.
Oh,
Second?
no, Frank. I'm not like
All in
that. Trust
favor?
me. Aye. Aye.
Aye.
Opposed? No, passes unanimous. Excellent. Jerry, then go on to the beneficiary designation, please.
Okay, so Stanley Schuler is now requesting to modify his beneficiary designation, naming his spouse, Suprema Schuler, as the new beneficiary.
Who's the beneficiary
you know what?
before?
I'm sorry, were you asking me something, Frank?
No, I think Joe asked who the beneficiary was before.
His sister.
You know, I don't recall us, just as a point, you know, it's been a while. I've been on the board a while. I don't ever recall that we've had an application to change beneficiaries.
I've been on longer and I've never seen one.
In
Right,
the 6 years I've been with the city, I don't believe that I have presented a change in beneficiary on behalf of a retiree. But again, that's not to say that it cannot occur.
Right. I mean, I'm just wondering because like Charlie's been on the board a good 25 years, I believe.
Yep.
And I mean, is there a system?
Frank, can you hear me?
Yes.
Okay, yeah, I've never seen this in the whole time I've been on the board.
How long ago did he retire?
He retired, he had actually an original retirement, which was in early 2020, and then we resubmitted his application under a disability retirement in September of 2020.
Okay, out of curiosity, doesn't a spouse have to sign off on a beneficiary if the other spouse doesn't choose him as a primary?
That is correct. And what happened in Stanley Schuler's case is, and I have it documented in his file to this effect, when he came in to sign the paperwork, his spouse was with him, and so she witnessed his naming his sister as the beneficiary at that time. And I made a note with the date in his personnel file to that effect.
Okay, so she was aware of the sister being named to begin with, like it should have been, and he wants to change it now back to his wife.
That is, well, he wants to change it to his wife.
To his wife. Yeah,
Yeah.
I got you. Yes, okay.
But if he was married when he got his pension, doesn't the spouse have to sign off that they don't get the pension?
I just said that, yeah.
Yeah. And so.
Right, and what I was indicating was at the time he originally retired, his spouse came into the office with him when he signed the paperwork in my presence, naming his sister as the beneficiary, and I have a note to that effect documented in his file.
Okay.
Only because I've never seen this before, and like I communicated with Charlie today about this. But I would think over 25 years, somebody gets divorced or their beneficiary dies or they get married. Are people aware that if they're going to change a beneficiary, that it has to come to the board? I mean, because again, Charlie can attest to this, that over 25 years, this has never come up. That's the only reason why I'm wondering about it.
Yeah. Well, there are 2 points to that. You're partially correct in that most employees are probably not aware of this provision because most employees have not read the pension plan document. But there are 2 scenarios in which a beneficiary cannot be changed, and that's either of the joint and survivor options, because those are spousal benefits only, and you name the beneficiary at the time you retire. And if your
pension amounts
if the
calculated
retiree-
based on the age.
Yeah, if the retiree dies, then again, the surviving spouse at the time of retirement is the only individual. So the either of the 50 or the 100% joint survivor options cannot be modified with respect to a beneficiary, but either the 5 or the 10 year, because it is a limited benefit payable. And in the case of Stanley Schuler, because he's been retired now since 2020, and as I said in my email to you, Frank, earlier today, when somebody retires under a disability pension, again, this is in accordance with the provisions of the plan document, the only payment option that is available is the standard, what we call the 5-year certain and life. And since he's been retired now for almost 2 years, his spouse has a limited entitlement to that benefit, because if he dies within the next 2 or 3 years, she will only get the benefit until the 5-year period expires. If he dies after the 5-year period, she gets nothing anyway.
Right.
Do you think as a suggestion on the application for a pension, could it be noted when somebody is listing their beneficiary that they should be informed that in the event that they want to change the beneficiary, they have to submit that to the city for approval by the board? Does that make sense to people on the board?
Yes.
It probably wouldn't be a bad idea for the city or somebody to once a year touch base with the people receiving pension benefits and just remind them to check their beneficiaries and make sure everything's the way it should be. But that's not, I don't know if that's our role or the city's role, but that'd be a nice service to provide.
Well, it's a suggestion we're making to the city because it does impact the board. Because we're trying to inform people that you will have to come in front of this board in order to,
Change it,
take approval. Right?
change it. Okay,
Is there a motion then?
Well, having heard all the discussion, I move we approve the change in Mr. Schuler's beneficiary.
I'll second
Is
that
there-
motion, Charlie.
All in favor?
Aye.
Aye.
Opposed? No. Thank you very much, Jerry, especially for the
You're welcome.
clarification.
My pleasure.
Next, Britt, would you like to introduce Artisan?
Sure, Frank, happy to. So we have Artisan, who's Norwalk's International Growth Equity Manager. We have Amy Fox and Sean Halley on the call here today. I have about 30 minutes, Amy and Sean. If you could touch on the team process, performance, outlook, that'd be great. Obviously, geopolitical situation in Europe is quite volatile. So any exposures there would be helpful, and kind of an outlook going forward would be great. And I'm sure the board will ask questions along the way. It's all yours.
Sure. Thank you, Britt, and thank you everyone for having us tonight. I'm Amy Fox. I work with the Global Equity team here in New York City. I am in our office in New York City, which has been great to be back with the team. Everyone's been here throughout COVID, so it's actually been really nice to have everyone together. And Mark Yockey, the PM, he's been in every day. So especially with everything going on right now, it's been really, really important to have everyone together. Jamie Sanderson, who normally is in front of you guys, he sent his regards. He was sad he wasn't going to be able to make it tonight. But I do have my esteemed colleague, Sean Howley, joining us from the West Coast. Some of you may actually recognize him. He covered you guys for many years ago, before Jamie joined. So depending on how long, it sounds like some of you have been on the board for a long time, so you may recognize him from those days.
Hi all, hey everyone.
So quickly, just before I jump in, I just want to make sure everyone has the materials that we sent over. We sent over a meeting book with it's quite lengthy, so I promise we're not going to go through every page. I know we'll keep this within 30 minutes, if not less. So, but I just wanted to. I'm going to go through the firm overview, team update, a little bit on the process, because that really is important to understand kind of where we invest, why we invest where we do. Which really helps frame some of the performance and exposures that we currently have. And then I'll turn it over to Sean to go into the portfolio a little bit more in depth. So quickly on the firm, if you turn to page labeled 2 at the bottom, this is just our quick firm overview page. So again, Artisan Partners has been around since 1994. We're a multi-boutique firm. So you can see these different boutiques on the right side of the page where we've now grown from the growth team. We started as a domestic small mid-cap growth company and have now grown to 10 different boutiques within the firm. So we have grown since 1994, grown to be about 175 billion at the end of last year, which is close to peak assets. So we're thrilled that even through COVID that we've been, the stability of the firm has been incredible and resilient and firing on all cylinders, and we're even been able to grow in this environment. So we actually brought on 2 different teams just in the past couple of years. The China Post Venture team, which is within our global equity team, where you all are invested in the International Growth Fund. It's a different PM, different analysts, but that's a new opportunity that the firm brought on in COVID, which is pretty impressive. And more recently, we hired an EM debt team. So just from a stability standpoint from the firm and navigating through COVID, it's really nice to see that we've been able to come out on top through this. At the bottom, you'll see how the assets are divided up. So again, this international growth strategy is within our global equity team led by Mark Yockey, and it represents the team overall represents about 20% of the assets. So at the end of last year, Mark was running about 23 billion across the international growth strategy and the global equity strategy that he also manages. And you can see most of our clients are institutional like yourselves. You can see that on the right side of the page where 64% of the firm assets are institutional. So a lot of similar people like you guys and that are sophisticated and are watching the markets probably just as closely as we are. So so again, we're thrilled to be here with you all and thank you for this opportunity. We do appreciate the business and this is a really tough time for all of us. So hopefully we can at least help explain our little corner of the world today. So if you flip a couple pages forward on page 4, so this is our long-term performance. Again, this is, the International Growth Fund is the cornerstone of Mark Yockey's team. He has more than 25 years of experience running this portfolio. He was, employee number 4, hired back in 1995, shortly after the firm was founded. And he has been using the same investment philosophy process since day one, which is more of a GARP, growth at a reasonable price approach. Which I'll get into in a second. But you can see, on this page how we've navigated several different market disruptions and market cycles, and sticking to our knitting, sticking to the process has really led to that significant alpha you see on the top left chart there. So while there may be some short-term, time periods where we may struggle with whether it's when aggressive growth at any price is really doing well, or if there's a dramatic value cycle. Those may be tough environments for us, but the majority of the time those numbers are usually pretty, or the range, the environment's pretty reasonable, and this portfolio has done really well over the long term.
And just for the board's edification, and Amy, so you're aware, Norwalk benchmarks the strategy to the EFA Growth Index. So the being shown on page 4 is the EFA index. It's not necessarily the same benchmark that we use in our performance reporting and monitoring.
Yep. And we do have the performance page later on in the presentation that does show you the returns against the growth benchmark. So we'll make sure to address that as well. But just over the longer term, we typically look at more of a core index just to see the broader market. So that's why we have that page in the book from an overall perspective. On the next page is the team. So just quickly, no real changes on the team. You can see Mark Yockey there, and he has 2 co-portfolio managers, Charles Hamker and Angie Redig. They've been working together for now about 17 years or so. So there's a lot of continuity at the top, seasoned leadership. You can see, their investment experience. They've been doing this a long time. So no changes there. We have added a few analysts in COVID, which again has been pretty remarkable, that we've been able to bring on additional talent through this. So we have hired, since the last time Jamie would have spoken with you all, we've hired Navdeep Singh on the healthcare side, and Joe Delgadillo, and he's a multi-sector analyst. But you can see, we have 18 analysts and associates that are usually focused on their sectors, but we do have a couple multi-sector analysts, and the team is split across 4 different offices around the world. So I'm here in New York. The majority of our analysts are here. Mark is here, but we also have our San Francisco office where Sean is. Angie Redig is out there. We have a slew of analysts out there, and we also have an office in London and Singapore. Particularly Singapore is helpful with the regional analysis over there. We really like having boots on the ground, and Stephen Chan leads that office, and he speaks local languages, which definitely helps navigating some of the markets over there. So this is a truly global footprint, global team, which has helped Mark make sure he understands all different perspectives of the different markets he's investing in.
Amy, has there been any discussion of succession for Mark or retirement in any time in the future, given his age?
Yeah, so we get that question a lot. Mark has no plans of retiring anytime soon. We do have, he has 2 co-PMs that he does lean on, that have been doing this a long time. But really the design of Artisan is to create this distraction-free environment for our PMs. So as we say, it's no heavy lifting and it's all indoors. So it's Mark, all he has to do is worry about the portfolio. He doesn't have to worry about managing the business. We have a whole C-suite that's running the business management side of things. And so Mark is laser focused on his portfolio, and frankly, that allows him he has no interest in retiring anytime soon. He also has, he's personally invested in the fund. So he's looking after his own wealth himself. And he's fully engaged. So no plans of retiring anytime soon. And Sean, jump in if you have any additional color there, but
Well, that's all true, Amy. I think that, Brett, I've probably been getting that question for the last, how long am I working with Mark? 15, 16 years. And I think I get it every year from some clients as well, but there's been no change. He's, as Amy described, he's fully engaged. He loves what he does. He's a stock junkie and he just loves investing. That's just the reality, but no plans to change any of that.
Yep, thanks. And I didn't expect any other answer from you guys, just had to ask anyway. Thank you.
Yep. Like you said, we get that question all the time. Well, unless there's any other questions on the team, I'm going to jump into the philosophy process really quick, and then I'll turn it over to Sean. But if you flip to page 7 and 8, we have our investment philosophy and process. And really at the end of the day, Mark and the team are looking for high quality companies that are benefiting from long-term secular sustainable growth trends and growth themes that are trading at attractive valuations. So you can see on page 8 how we do look at each of these pieces, equally with a thematic overlay. So Mark and the team, they identify where these secular long-term growth trends live from a thematic basis. And then, this helps direct the analysts' research efforts to go find the best positioned companies to benefit from that long-term theme. And this is where, we are truly a GARP strategy. So, we do live kind of in between that core and growth, depending on, where the opportunities are. So again, we do have the growth benchmark and the materials. Some of our clients, a lot of our clients do use that. But sometimes having the valuation discipline can keep us in some of the not so aggressive growth areas. And even sometimes, it'll be characterized as, not true value, but some more value characteristics in the portfolio, just that's where the opportunities are. So it provides the flexibility for Mark and the team to just find the really good ideas no matter where they are. But again, with that sustainable growth overlay to the portfolio. The following page, you can see some of those themes that I mentioned. These overarching themes, demographics, technology, environment. These are themes that Mark has identified really since the beginning. A lot of those have not changed. It's really these sub themes that evolve and change as the environment changes. So again, this is really to help focus the research team, direct their efforts, and how they find the best opportunities for the portfolio. Any questions there before I turn it over to Sean?
So good.
Okay.
All right, well,
Thanks, Amy.
Yep, go ahead, Sean. I was just going to say, if you the market review starts on page 16. If you guys want to turn to that page, and I'll turn it over to Sean.
Thank you very much. Thanks, Amy, and good evening, everybody. Thanks for inviting us. Yeah, so page 16 of your deck just deals with the market review. It summarizes, by local currency terms, and how each sector performed overseas. And this is the index. This is the ETH index, to your point, Brett, the generic index. Well, you'll see, for example, utilities had a very strong quarter. Surprising. I haven't seen utilities top of the charts for some time, but that reflected the uncertainty around rising rates because they tend to do better in a rising rate environment. Over the full year, you'll see some extraordinary differences in returns between sectors. If you look at communication services, up a mere 1.9% for the year, but things like, for example, energy close to 29%, and technology over 30%, almost 31%. So a huge dispersion in returns between sectors internationally, just like we saw effect in the domestic side of things too. But as you know, international markets tend to be less pronounced in terms of technology or things like that. So there are fewer companies overseas in those high growth sectors. So in summary, in local currency terms, and I'm saying that because the dollar obviously suffered a little bit last year. In local currency terms, for the quarter, international markets were up about 4%, and for the full year, up about 18.7%. As we look back on last year, the US outperformed everybody, outperformed the rest of the developed markets. and they in turn outperformed emerging markets. Because as you may recall, China was going through some turmoil last year. They're cracking down heavily on some of the tech companies in particular. Thankfully, we avoided much of that carnage by exiting our Chinese holdings in the first half of the year. So we avoided a lot of the carnage that really began around July of last year. So essentially, US outperformed, international outperformed emerging. As you turn to page 17, you just get a snapshot of performance over different time periods. So you'll see, just sticking with the December numbers, for the final quarter of the year, we were up about 2.5%, the EFA growth index about 4%, and the core EFA index about 2.7. For the 1 year, we returned about 8.4, the EFA growth about 11.25, and the EFA index around the same. But as you look at longer time periods, you'll see, excuse me, that our returns tend to fall, as Amy described, somewhere between EFA growth and core. And because of that valuation discipline, the last, 7, 8 years have been dominated by ultra high growth, high momentum growth. And our valuation discipline keeps us away from that. So we tend to live in that in-between land between core returns and growth type returns. And that's borne out over the subsequent, 3, 5, 10 years, et cetera. Since inception, we've delivered, close to growth index returns of about 9.4 compared to 9.5, but ahead of the EFA index. And since the inception of our strategy, which sounds like it's around the same time many of you have been on the board, about 25 plus years now, we've delivered over 10% annualized, whereas, both benchmarks, whether it's core or growth, have been up about 5, 5.25. So over time, we've compounded, obviously, a significant alpha there. As of the end of the year, assets were coming in at just shy of 42 million.
Can I ask, I don't mean to interrupt, but I have a question.
Sure.
We have, the report we got from the city is that over the last 5 years, Artisan is up 9.7%. So, but you have here, 12.2%. How is that? Where's that? Maybe Britt could ask, am I missing something?
Yeah, Frank, you're looking at numbers through January. These numbers on the right in the presentation are through December. So obviously January was a pretty significantly negative month. But we can certainly check the returns and confirm with Artisan after the fact and make sure that everything is
I mean, but to change by 300 basis points over 60 months in 1 month would seem to be rather extraordinary.
Tend to agree with you. We'll go back and look at the data.
Thank you.
Thank you. Appreciate it. I assume you're more focused on the 1 year review rather than diving into any particular quarter. So if that's the case, I'm going to look at page 19 in our deck that summarizes attribution performance across the trust compared to the growth index. So page 19 shows you a lot of numbers, and I'll try to summarize this briefly. The lower right part of the page shows you the relative underperformance. So we're down about 152 basis points gross. The number next to that is 79, which means we were positive in terms of stock selection. And the number next to that, negative 231, is negative allocation results relative to the growth index. So as you look at these numbers and look at the various columns, I'll try to just cherry pick the larger numbers and explain maybe the rationale or what's driving some of those numbers. So for example, the top line, communication services, all the way on the right, we've got a positive 240. That's a good result. That means you're outperforming within this sector. We did add a lot of value in stock selection there because our returns came in around 30% compared to the index level of minus 18. And that's largely attributable to Alphabet or Google that we have in this portfolio, which may surprise you, but we do own some US names that are truly global in nature, like Alphabet and Amazon too, for that matter. But Alphabet was certainly a big driver of returns within this sector, and that has helped. On the flip side, there are some negative numbers too. So as you look at consumer discretionary and financials, they're both negatives, and industrials negatives. On the consumer discretionary side, excuse me, we did not own a lot of household durables, and there's a lot of a rebound in spending around the world with COVID. as consumers were trapped at home and a lot of spending took place at home. We didn't have a lot of that. So the absence of those stocks hurt our performance. Plus we didn't have a lot of luxury names, and luxury goods did quite well within consumer area last year as well. So some of those were the driving forces there. On the financial side, there's been a big rotation since the end of 2019. Once the vaccine was announced, financials began to take off, particularly among banks. Those expectations for higher rates suddenly became very apparent around the world, not just here in the US with the Fed raising rates, but around the world, there was really expectations that the ECB and others would raise rates. And in that kind of environment, banks tend to do well because, as you know, banks make the money between what they lend to us and what they pay us on deposits. And as rates go up, that spread gets wider, and that's where they make their money. So those expectations were rising everywhere. We were getting into banks in the beginning of 2020, maybe not quickly enough if I was to be self-critical, but we did get there by the end of the year. But I'd say the first part of the year kind of caught us off guard, and we were a little behind in terms of our exposure to banks. We had a lot of capital tied up in things like exchanges, like Deutsche Börse, the largest German exchange. That company doesn't tend to do well in a rising rate environment. It benefits from volatility, and it certainly is a big beneficiary of the environment today, with given the events going on in Ukraine and Russia. So it was a combination of not having enough banks at the time when they were really running hard. If you look at the other sector that was the biggest negative on the page is industrials. Our return was barely positive, up 76 basis points, whereas the index component was up about 13.5. The issue for us there was, buying into some airlines, in particular British Airways and Ryanair. We had hoped to see a rebound in travel. Quite frankly, expectations were high in the spring that COVID would be kind of largely behind us in the summer. But we all know what happened in hindsight. The travel markets never really opened up. Even later in the summer, we saw, Delta getting stronger. We saw Omicron kicking in again by the end of the year. So the reopening trades were very much muted, particularly on the travel side. And owning British Airways, where their key asset is, the route between Heathrow and JFK, that never really got going, even though the US opened up that route as late as November. But as you know, it was all for naught because the Omicron variant essentially killed any travel at that time of the year. So both of those stocks were down. They were, in fact, among our best performers in the first part of this year, until, again, events in Ukraine have taken over that. So a combination of Ryanair, British Airways, and MTU Aero Engines were largely responsible for our underperformance within the industrial side. So it tends to be more cyclical, but we do believe that long-term, those companies will do fine. The airlines will recover, travel will come back. It's going to take a bit longer now, given the events in Eastern Europe. If you go ahead one slide, you'll see some of the names that are really driving performance in both the quarter and the year. But again, just in the interest of time, I'll maybe just focus on the 1 year. So among our strongest contributors at the top of the page, Alphabet was up, 65% for the full year, largely driven by, growth in digital advertising and YouTube, all of those things you've read about. Thankfully, we own that because that's been the beneficiary of global advertising trends as well. Linde is an industrial gas company. They merged, as you may well know, locally with Praxair about 3 years ago now. They are the largest industrial gas company globally, and they're also a likely beneficiary of LNG terminals that are likely now to be in demand in Europe, given the world is shunning Russian oil, and that means a pivot to natural gas, and Europe has been embracing natural gas more openly. So Linde will be a beneficiary of those trends, as well as the move towards hydrogen for transport. They're among the leaders in the world in that field already, as well as Air Liquide, a company we own in the same space. So both industrial gas companies will do very well in this current environment and have actually done well last year as well. DSM is a company that does health and animal nutrition. They went through restructuring last year, focusing on these higher growth businesses. That stock did very well also. It was up a positive 43%. Animal nutrition is particularly important because it's a key contributor to greenhouse gases, and they have a very interesting product that we believe will reduce methane emissions from farm animals. Capgemini is a consulting firm that's helping companies migrate their IT back office to the cloud. together with Accenture, they do very similar businesses. Capgemini was up about 75% last year. Accenture was up about 60%. So both were strong contributors to that category. And finally, Aon, insurance broker, sits in the middle of insurance companies and clients or buyers of insurance. So think of corporate buyers who need data protection, who need climate protection, need key man risk insurance, who need property casualty insurance. They're a broker who sits in the middle, and they get a commission. And there's an increasing number of products with rising prices, so their commissions go up. So it's a very well-run company, now based out of London, as you may know, and they continue to do very well, but the stock was up about 44% last year. On the flip side, the airlines, as I mentioned, IAG, which is British Airways, or International Consolidated, was down about 14% for the year, largely because their market was shut down, volumes of passengers never materialized. And Ryanair was down about 6-7% over the full year, having kind of been down more and then came back up and down more. Very volatile, just like you'd expect a cyclical industrial stock to be. But it is the lowest cost carrier in Europe. They expect to carry over 400 million passengers this year, and they're still maintaining those numbers even with the current turmoil. So we expect to see their low cost advantage continue to work to their benefit. We did own Midea, which is a company that sells air conditioning units. It was a Chinese company, which we'd sold out in Q3. It was among a small position, but it was a drag on returns given the lockdown in China, given the pricing constraints that the government is putting in place. So we are out of China completely now. That was a fairly small holding. Finally, Ascendance is a Danish company that does drug delivery. They take successful drugs that are already approved by the FDA and others around the world. And in their case, their successful invention has allowed children's growth hormone injection to be converted to a once-a-week tablet. So it's a convenience play for parents and obviously for kids who are in need of that drug. But they are working with other partners, and they expect to develop similar technologies to convert injectables into drugs. So very innovative companies. But the reason it was down was because success came all at once for them. They're approved in multiple regions around the world. They now have to ramp up their spending on sales and marketing, which delays cash flows and profitability. And given the environment of long-tail growth companies really getting punished at the end of last year and indeed this year, similar to tech and biotech companies, this company was down. Having had approval last year, it was up at one point about 50% during the year, but at the end of the year down about 20%, just given the headwinds facing biotechs in general and that higher cost structure that I mentioned. We did have some transactions over the course of the year, particularly at the end of the year.
Could I ask a question?
Yes.
One of the things is that a number of the people who run money for us, when they break it down specifically, not by just a region, but by the country itself. Mm-hmm. And one of the things you have money, how much do you have in, like you have the bank in Russia, Sberbank, I think it's called. Right. And do you still own that? Mm-hmm. And do you have any funds did you own any Ukrainian stocks?
No. No. So just to
and how much money did you have, say, at the end of December in Russia?
It was about 2.5%. We had between Sberbank and another company called Norilsk Nickel, that is one of the largest nickel producers in the world. We didn't sell either one. We've marked them down to zero as of last week because of the illiquidity. The stocks are not trading, as you know. Sberbank is on the sanctioned list, but it's just not trading anywhere. So like other managers around the world, we've had to mark that down to zero to reflect reality. The likelihood is that Norilsk Nickel is it's an essential company in the world for electric vehicles because you need high grade nickel to produce extended life for electric batteries. And they produce 50% of high grade nickel in the world. They already produce 30% of GM and Ford's need, for example, in their electric vehicle lineup. They also, their costs are in rubles, their revenues are in dollars. So it's a highly profitable company. They're not on the sanction list, and we think because it's an essential component of the global supply chain. The other product they make is palladium, which is used in catalytic converters to reduce emissions from particularly trucks with heavy emissions. And that again is part of the EU and the US mandate to reduce greenhouse gases. So both are essential products or commodities that we think won't go away. We haven't sold them, and nor can we sell them, quite frankly, right now because of the market is closed, the exchange is closed, and nobody is trading them anywhere. So we have to wait and see how this outcome plays out. But we think there's significant optionality in the upside for Norilsk nickel. We're less sure about Sberbank, quite honestly, Frank. Even though it has 60% market share in Russia, it's on the sanctioned list and may see an outflow of funds from index funds as they're forced sellers, likely when markets do reopen.
You mentioned the sanction. Can you talk about the sanctioned list for a moment? How long ago was that issued? Because the papers are saying that Biden's order from this week forbids any investment in any Russian security, according to what the newspaper report said.
So any new investment, so legacy investments have no choice. You're frozen in those right now.
There's no way to dispose of it. There's any way to put it into a trust, any way. Because I mean, I don't want our fund to get to be in violation of a federal government order this week because you own something that we're not allowed to own. Anything you can do about it?
Question. We've got that from a number of our public clients, but I think the reality is that they're just so illiquid that nobody can get out of them. So I think the orders really speak to new additions or additional money going into those securities. But again, that's almost a moot point currently because you can't trade in any of these names right now. I think the only things you can trade in are corporate bonds in Russia because they're not on an exchange. They're more private markets, right? But I don't know, Britt knows much about that, but that's not my area of expertise. But for now, we're just frozen out of the Russian liquid equity markets that we had a small exposure to.
Yeah, and Charlie, maybe just to provide some more color, and we can discuss this after the presentation.
Yeah, please.
All of the indices, all the index providers have removed Russia from their indices. So Russia is no longer a part of the ETH index or the ACWI US or the emerging markets index. The reality is that except after pretty much the end of February, all of these markets have seized up, closed, all of the exchanges have closed, even for US investors trading ADRs or GDRs. There's no buyer to buy them. And right now, essentially you have these potentially worthless securities in the portfolio. There is an upside to Sean's point, but there's nothing that anyone can do about it right now. So it's really wait and see. I mean, we're at the start of clearly a humanitarian crisis that could go on for months or years. And honestly, the outlook, whether Russia will open up its stock markets to the world again, whether any country will change its foot on sanctions, remains to be seen. So Norwalk is not alone in this predicament. And unfortunately, the reality is that there's nothing anyone can do at this point in time.
Sean, one quick question follow-up on that. You mentioned 2.5% in Russia. How much of that was the nickel company versus the bank?
Yeah, we have the holdings right at the back of your book. So you'll see on page 26, it's 1.5% in Norilsk.
Okay.
And 1.2% in Sberbank.
Okay.
2.7 at the end of this.
Sean, I assume that's as of 12/31. So
That's
those allocations would have been much, much smaller in the past few weeks.
Yeah, and that's we mark them to zero. So you think of those as zero today. That's just a price move, but we still have the similar number of securities, right? So based on just the market moves.
So will your performance, you took that in March, so the performance could be taking a 2.7% hit?
That's right. That's right. It'll go straight to the bottom line. That's right. That's the reality of it.
Well, the nickel company has to be a good long-term investment. There was an article in the journal today on them.
Oh, yeah, I missed that, but yeah, I mean, nickel prices have gone up a ridiculous amount, and here's a company that's
60+%.
Yeah, right. Yeah, we think their revenues have, gone up from what, 15 to 40 million a ton in the last week or so. So, if they were open right now and these commodities were behaving as they are, this would be more profitable than ever. But that's not reality. So, we got to wait and see how it all plays out. But it's a function of being an active manager. As you know, we have the discretion to find opportunities like this. At times, it has paid off significantly for us in the past by getting into far-flung corners of the international markets. Thankfully, most of the time that has paid off. This particular time, it's not, but we're still hopeful that we'll see a recovery, at least in Norilsk Nickel. We're less sure about Sberbank, just given the sanctions and where that'll play out. But we do think there's potentially significant upside in both, but particularly with Norilsk. The good news is that we've seen a rebound in markets today. Germany was up close to 8%, as you saw, and even some of our airline stocks up 11, 12%. So there is I can't say that it's a long-lasting trend. It's a single day amid a sea of red in the last week, but it's certainly a nice change of direction to see the markets rebounding today, in the hope of lower oil prices, and hope of potentially peace talks and other dynamics driving the market, including some investors saying this has gone too far. So it remains to be seen how it plays out, Frank, but it's certainly a very relevant question given what's happening in the market today. Maybe I'll just show some of the top 10 hot holdings just to give you a sense for the quality across the majority of the portfolio. Page 22 kind of speaks to the larger names. You'll recognize a lot of these names, but they do kind of give, to me at least, a good sense of long duration quality that's here in the portfolio. Linde, as I mentioned, is now the largest industrial gas company. You need industrial gas for everything, including oxygen for hospitals, for making steel, for making computer chips, for your barbecue gas, for keeping your vegetables cool to and from the supermarket. Capgemini, I mentioned. NICE is an Israeli company that does software for call centers. So that was a very good stock during COVID because it allowed the employees of call centers to remain at home and work remotely by simply providing them with a software that allowed them to work from remote locations and basically saved these call centers a lot of real estate expense. And a lot of these companies have gone virtual permanently. BNP Paribas is a French bank that's done quite well. They recently sold off Bank of the West here in California for an unexpectedly large price. They're a key beneficiary of rising rates in Europe, and that stock has performed well for us. Deutsche Börse is the exchange I mentioned in Germany. That's the largest exchange in Europe today and is a clear beneficiary of the volatility of the last few weeks. Just to pick out another one, Deutsche Post is better known as DHL. It's the DHL brand. It's like the FedEx or the UPS of Europe and Asia. And they're a clear beneficiary of the long-term sector trends that consumers are shopping more online. They're beneficiaries of the supply chain and the logistics problems you've been reading about. Pricing has gone up for them significantly, and profitability tends to follow their pricing. So these are the top 10 holdings representing more than a third of the portfolio. But it speaks to the quality that's embedded in the portfolio. And we think that these are the bigger drivers of performance over the long term.
I have a question. How much Russian exposure does BNP have? Do they have a Russian subsidiary?
No, they do not. We looked at our banks yesterday. BNP is not among them. No.
Thank you.
Maybe slide 23, just to give you a sense for how the larger holdings have actually performed over the last year. This slide is interesting because the larger the bubble, the bigger the weight in the portfolio. So in an ideal world, what you want to see is all bubbles up and to the right, but especially you want to see the larger bubbles because these tend to drive your returns. So the bigger bubbles here, as I can see, are mostly up and to the right. But there's one or two exceptions that hurt us last year. Those are no surprise, the airlines like Ryanair and IAG and Ascendance that I highlight in the report. But you do want to see these bigger weights, these bigger bubbles up and to the right. And over longer periods of time, that has clearly been borne out by stock selection results that have been, generally been more favorable, more positive over longer time periods. So where do we sit today? As you look at slides 24.
Excuse me, are those relative returns or absolute returns?
These are absolute returns.
Why are we looking at absolute returns when we're evaluating you on relative performance?
Well, we've just shown you the absolute returns because some of these are out of benchmark. We can do relative as well if you'd like. We can do that as well. It would show you just the alpha then, right? So the alpha return from the stock.
Right. That's what you were touting in your first part of the slide, first part of the presentation was how much alpha you delivered, and I think it's strange that all of a sudden now we're talking about absolute returns.
Okay. We can certainly show you the alpha generated from these ones. Slide 24 and 25, maybe I'll wrap up with these, but the lower right corner of these slides shows you the latest positioning, if you like, by sector. The other charts are, the top charts show you the benchmark and the portfolio. The lower charts in the slide show you the active weights right now, but the one on the lower right shows you the latest one as of December. So in other words, the biggest overweight today in your portfolio is financials. We're about 10% overweight the growth index. And we think that will be a key beneficiary of rising rates. And even though that has been stalled and debated over the last few weeks with whether the Fed will raise, we know that rates have to go up. So we think our financials exposure will benefit from rising rates, a combination of the banks as well as exchanges in Europe that will benefit from the volatility. So we're pretty comfortable with that exposure right now. Materials for us largely means industrial gas. So as I mentioned, both Linde and Air Liquide are likely beneficiaries of this conversion to LNG and to more natural gas consumption. The US supplying Europe with more natural gas over time, we think will benefit both of those companies. On the flip side, we're most underweight the consumer areas right now. Staples for us we've largely been out of staples because of our concerns over lack of growth and valuation. You tend to be overweight consumer staples if you felt there was a recession on the horizon, and we certainly don't see that. Economies, at least till this point, have been very strong. Unemployment is still coming down. There's so much excess liquidity in the system still post-COVID, and we think that will shield the US and Europe from a recession in the near term. There's still a lot of savings, pent-up savings that are in bank accounts in the US in particular that will protect the US from recession. But as an active manager, these are residual effects of stock selection for us. We're not trying to make these statements, but these are residual effects. If you turn to the regional slide on 25, you'll see where we're positioned relative to the growth index again. Lower right, again, just the key metric shows the latest ones. We're most overweight in the Americas right now. So that's a combination of Canada and some US securities that are out of benchmark, like Amazon and Alphabet. We own a couple of Canadian stocks that are contributing to this as well. So that currently is about 14% active weight. It's all out of benchmark. We're about 7% overweight Europe. We've tended to have an overweight in Europe over time, and that's been, over long periods of time, has been a bigger driver of our alpha. And we've been underweight Japan for as long as I can remember, currently at about 19 or 18.5% underweight. It's a combination of things there. We look for Japanese companies, but we rarely find companies that meet our investment criteria, either from a growth or valuation perspective. And we do have some. We have Sony and we have Hoya. Hoya is an interesting company. They do things like glasses and contact lenses, but the same glass is also used in hard disk drives in hyperscale data centers. And as the data centers of the world get full up on data, they need to move to the next version of technology. And we believe that glass will be the next version, replacing these aluminum discs. So Hoya is well placed to benefit from this migration of data center storage to glass discs. So those are some of the Japanese holdings, but in general, as you can see, we're significantly underweight Japan. And that position has really worked to our advantage over long periods of time because, as you know, the Japanese market has really failed to recover from its woes of the mid 1990s for since then. So So that's our story. It's been a disappointing year of missing performance against that growth index, but we certainly think growthier parts of the market have come off the boil, as you've seen recently. There is a move towards more cyclical parts, and we think our positioning in terms of getting into some financials and industrials, including those industrial gas companies, should begin to pay off. But we have to wait and see how we get through this crisis, because the whole market has been in turmoil and not really moving with any clear direction. It's a lot of companies have been moving down just because of geopolitics on headlines. So when the dust settles on all of this, I think our stock selection should begin to come back. We have been through crises like this before, and we've usually come out of them in pretty good shape. So I'm pretty confident that Mark Yockey and team, given how long they've been running money for and have given their pedigree in terms of stock selection capabilities, should begin to shine again. So obviously that's our wish and our hope that we do that for you before the year is up.
Can I ask how much cash you have right now?
Mm-hmm. It was 1.6% at the end of the year. Hasn't meaningfully changed since then.
And so you haven't, how much do you feel you have dry powder to put to work?
Well, we always have a pipeline of ideas, and then some stocks that are nearing their target prices. So we're typically selling stocks to raise liquidity for dry powder for purchases. But our benchmark is fully invested, so we never keep more than frictional cash on the books. Like 3 to 5% would be high for us. We don't keep 10% cash back, for example, waiting for opportunities like this. It's
I wouldn't expect it, but I was just wondering if you're up towards your upper end of the band or lower end of the band. It sounds like you're at your lower end of the band.
Right. Currently, we're there.
Any other questions?
No.
No. Thank you very much for the presentation.
Appreciate it.
Thank you.
Thank you very much, everyone.
Thank you.
Stay safe.
Guys.
Thank you.
But, should we discuss Artisan? Does anybody have any comments or questions? Or Rick, do you want to make anything, say anything about them?
Sure. First, I did want to note, Frank, that their performance does match our fourth quarter performance. There was 3 different tiers of performance they showed on that one page, and the tier 1 is exactly what Norwalk's track record has been, and that is correct in our performance reporting. So I did want to clarify that.
But it was not the same as what we have for 5 years, is it?
Yes, it's all the same. I can send the board a note afterwards. But essentially page 17 of the Artisan presentation, the first line, Artisan International Growth Trust.
Your 5 years at 12.2%.
Yeah, I checked also. That's what we have in December report from calendar.
Yep. At the January report, you will not see, we will not match these numbers, but the fourth quarter.
Okay,
full report.
well, the one thing, the January report at 9.72 and 12.7. I mean, that's an extra, wouldn't that be, that's 3% over 60 months?
Well, it's the endpoint impact. Yeah,
Right,
the
you can
endpoint
see
went down.
The index was down over 10% in January.
Beginning and ending points make a big difference on 5-year numbers.
Yep. But in general, Callan still has conviction in this team. As I think Sean mentioned, they really aren't a true growth manager, and they're not going to keep up in the growth markets that we've seen over the last 7 to 10 years. There is a quality and evaluation component to this strategy, which, I think in January with the index down over 10.5%, and the portfolio, while on an absolute basis is still negative, they outperformed by over 4% versus their benchmark. I would expect in a volatile down market that their quality and valuation bias will help their performance relative to the growth benchmark. That being said, their performance versus the EFA Growth Index since Norwalk has hired them has been disappointing. But from a talent perspective, I think we still have a lot of respect for Mark Yockey. He's definitely the key man on this strategy, which is why I asked about potential retirement. But we believe in the team, we believe in the philosophy, and it's one of those strategies that takes patience. And because they're not tracking to a benchmark, they're really more benchmark agnostic. They're going to have volatility and differences between their return pattern and the benchmark.
Hey, Brett,
Go ahead. I'm sorry, Joe.
a housekeeping question, maybe he addressed it, regarding the Russian securities. Are they written off on the indexes as well, Brett?
Yes, they should be.
In
So
the same time frame, so that everybody is equal? Is that how it works?
yeah, as soon as it's removed from the index and given all of the orders and the entire industry within really the last week has all done the exact same thing. So
Okay.
I don't think going from a relative basis, that shouldn't necessarily come out as some extreme bad performance. It should be in both ends, both the benchmark and their.
Okay.
How much weighting does Russia have in the benchmark?
And the-
I mean, that would be
So-
make it, if the benchmark is only 1% Russian and they're overweight, that would make a difference.
So what I can tell you is Norwalk's international equity portfolio is benchmarked to the MSCI ACWI ex-US. Okay, so this is a broad non-US international equity benchmark.
Okay.
At the end of December, Russia represented 1%.
So that
Of
means
that
they're gonna take a 1.7% hit. That's
Well,
greater.
that's a different index than Artisans. But I can tell you that Norwalk's international equity portfolio, which includes Silchester, Artisan, and BlackRock, had a Russia allocation of 0.4%. So 0.4%,
20 basis
about
points.
60 basis points less than the index.
Silchester-
Silchester had no exposure
Right.
to Russia. BlackRock had about 3% Russian exposure relative to about a 4% emerging markets index weight. So yes, Artisan and BlackRock will certainly have negative performance given these write-downs on an absolute basis, but to Joe's point, the benchmark is removing them as well, and it will be reflected going forward.
So on a relative basis, all things being equal.
But it's not equal, unless I misunderstand, it's not equal if the weighting is 1% of the index and they have 2.7%, they're overweight by 1.7%. So when the index goes down 1%, an Artisan's going to go down 2.7%, or am I misunderstanding something?
So I think it depends. So the hard part with all of this is depending on the time period, the endpoint that you're talking about, the allocation size is very different because since the end of last year, we've seen essentially valuations for all Russian stocks plummet to the point where now you can't even trade them. So if we're talking the end of February versus the end of December, the allocations within the index and the allocations within these funds are going to be significantly different.
Right.
So I think what Sean was referencing was towards the end of last year was an allocation of about, I think, 2.7%. That is less than 1% as of the end of February.
Right, but what was the weighting at the end of December of Russian stocks? If it was 1%, they're still 2.7, they're 1.7% over.
Let me pull up the,
They took that hit during January. In February, they took that hit already.
so I
Well,
think,
It sounds like they took half of it in January and the rest of it has come since.
Right.
I think they marked it down to 0 last week, so they didn't take the hit until March.
No, they took a market, they took the market hit in
January.
in January and February. And then on a mark-to-market basis for March, they had to take
They
all the
went-
residual value out.
Right,
Right.
but we don't know how much that was.
Well,
Because they weren't traded.
If we would need to know what the end of February allocation was.
Right.
So the end of February, their allocation was less than 1%. They had 81
So the
basis
additional
points
hit-
to
The
nickel
additional hit
and
they took is less than 1%. And then if I can, can you get them to do chart 23 on a relative basis? I mean, they're talking about their great stock selection, and then they come up with a chart that's on absolute basis. I wasn't a real fan of that.
yes, I'm happy to request that.
Okay.
Still a little concerned about this ownership of anything Russian in light of what I've been reading in the papers. And looking through what he lists in the portfolio, he's got several companies that say they're multinational. You previously asked about the bank, and they don't have a Russian subsidiary. But what about all of the others? Are we required to make that kind of a search and divest anything that has any ties to Russia? Has anybody done a study of the latest federal orders?
I'm not aware, Charlie, of any order demanding investors to divest from Russia. That being said,
Okay, let me say, I'm not aware of an order, but the newspaper reports are saying, yes, that was the gist of the order. Part of the order stopping any importation of Russian oil. I don't know, somebody more knowledgeable than me needs to look at the text of the order just to make sure that we're not doing anything that we should be doing.
from every client and every person I've spoke to about this, you are not doing anything incorrect. The reality is that even if the order was that every American pension fund had to divest from Russia, there's no way to divest. So you'll see.
Well, there
I
might
have
be
number-
if it was a stock in a company that has some trade with Russia, but the company itself is not Russian, not primarily Russian. Should we divest that as well?
You're talking about US companies too, Charlie.
Well,
mean,
I
you're
know, I understand
You're
that.
talking about not just,
Absolutely. I'm
mean,
just
that's-
using this as an example because he specifically mentioned a couple of them as being multinational.
all companies are multinational now, mostly.
Yeah.
What we don't know is, like, say, does a French bank, even though they don't have a branch in Russia, do they have outstanding loans to Russian corporations?
Well, that seems to be the gist of what the newspaper said. Anything that's done to invest in Russian utility companies, Russian oil production, et cetera, we need to divest.
Yeah,
I don't know.
what Charlie's referring to, I just pulled it up here. There's an article today that the state of Connecticut is going to divest Russian-owned assets from their retirement plans. That's the state, that's not us.
No.
And
Yeah, I think the difficulty is, because I have clients that have also chosen to divest from Russia, but there's no way to do it.
Yeah, that
So you
part I
can say it.
understand. That part I
It's really
understand.
more
but-
political than anything, because yes, if you had all separate accounts within the portfolio, you could certainly choose to divest from all Russian securities. And if and when they ever trade again, then the managers would absolutely sell them. I think at this point, it remains to be seen if and when those markets will open, when they will trade, and if there is any value at all at the end of the situation. you know, it's. Go ahead. Go ahead.
You can't divest something that doesn't have a market, right?
That's certainly true. When you're talking about a Russian-owned company or a company headquartered in Russia, suppose we own stock in the Bank of America and they had 40 branches in Russia. Do we have to divest we have to require any of our managers to sell all their Bank of America stock?
You know what? I mean, remember, almost every company in the United States, I mean, look, we just had the McDonald's, Starbucks. So I don't think that that's the case.
I remember, I'm a lawyer, and these are the kinds of questions that we look at all of the time. Do we have any exposure?
You know, believe me, there's been a lot of times where that's been very helpful to the board.
All right. I mean, if everybody's satisfied, it's okay.
Yeah,
I'm just worried about our exposure.
Right. I mean, the one thing that.
Yeah, I was saying, I don't have any concern with this. This is a politician at the state level making a decision for the state funds, and I don't know how he's going to do it anyway because there's no market.
No, understand me. I'm talking about something totally different. President Biden issued an order, a sweeping order, banning importing any oil from Russia and ordering, it seemed according to the newspaper report, ordering the divesting of any shares in companies which are funding Russian utilities, funding Russian fuels, funding Russian companies. So it seemed a lot broader than just divesting a company that's a Russian company exclusively. And remember, this is Biden's order. It's a federal order.
Charlie, I think you're making a great point, and Britt, you know, that I guess this is something you're tasked with that Callan investigates and will report to us.
Yeah, find the text of Biden's order and tell us no, it doesn't apply because.
Charlie, we're not going to solve it here.
Yeah, I know. That's why I'm raising it as a question.
And I think the next step is to let Callan go out and have their legal people look at this and then report back to us.
Good.
Sure, happy to.
Good.
My assumption is that directive applies to companies divesting, which would not necessarily be Norwalk divesting from the manager level, but it would be, you know, people like McDonald's responsibility to divest themselves, which inherently will assist Norwalk in divesting from them, but we're happy to look at it. And I don't know, Charlie, if you have that article or what you're referencing, if you can send it over, that'd be great.
I'll try to find it and send it.
That'd be great.
There's an article on the Treasury, U.S. Treasury's site. I just Googled U.S. government order to divest in Russia. And if you put, there's a treasury.gov website there that basically U.S. persons may not buy or sell debt or equity. So you can't buy it, you can't sell it. That means it's because the market's frozen. So I don't see any issue here, but it's worth looking at.
Yep, we're happy to look into it.
Okay.
You know, one thing that looking at Artisan, I mean, two of their largest stocks are FANG stocks, right? Amazon and Google. And I was looking at today, I got the report from Silchester. Silchester has like 0.5% of their money in the United States. And just in those two stocks alone, you know, Artisan's got 6.4% in the United States in a highly volatile, you know, in what I would consider volatile stocks. And if you look at the performance of the two over the last several years, Silchester's outperformed by over roughly 340 basis points from their benchmark. And Artisan is underperformed by 275. And Silchester's also outperformed by what, 170 basis points. than Artisan. So it seems that, the developed market side of our investment has been much better for performance by Silchester than by Artisan.
Yeah, to build on your statement, Frank, my concern would be is if we're making an allocation to a specific strategy, and if they're generating a significant part of their relative of their performance from names that are not in their mandate, then I think that leads to an overrepresentation of what their performance is relative to their mandate and relative to our allocation. And so I would like to see more of more closely or somehow getting a better understanding of how much they're deviating from the mandate and how much of the performance is from the mandate. I mean, there's no argument that Google or Alphabet and Amazon are international stocks, but we decided we have an allocation to the U.S. markets to get exposure to that.
And by the way, I should compliment you because you were the one who suggested that we added more money to Silchester a while ago, and they've done quite well.
Well, yeah, I really believe in their process was unique. The outcome has been good. I'd like to see a little bit more of a comparison for Artisan, in mandate, out of mandate, and how much of their performance is driven by, it's fine that they have, they've selected these stocks. That's terrific, but that's not what we're allocating them to them for.
Yep.
And so I think, Britt, if we can, go back to them and try to get a better understanding of I don't necessarily care that they're not in the index, but what I do care is that they're U.S. companies.
Yeah, Britt, does Callan track those statistics by manager where, percent of their portfolio that's not, outside of one of the index holdings?
Not in our reporting. What we can do is ask Artisan specifically for more detailed attribution to get down into what's driving performance. And to your point, Rich, on specific out of benchmark name selection.
I don't care. I don't necessarily, if they were an emerging market company, if we allocated to them on an emerging market basis and they invested in a Korean stock that's not in the MSCI emerging market index, I'm happy with that. That's fine. But what I do care is that if an emerging market index was delivering most of the returns or a substantial part of the returns from Alphabet and Amazon.
Yep. What I will do is ask for out of benchmark attribution from them. So the name specifically not in the ETHA growth index and their performance so that you can see, when they have gone out, which they do often because they really aren't constrained in their philosophy with the benchmark, which might be the entire problem here, right? I mean, we have an international growth manager and an international value manager with Silchester, and they're supposed to complement each other and track different indices. And Artisan's approach obviously is not as tied or constrained to the benchmark and the names affiliated with the benchmark, which does cause noise and can certainly hinder performance or help performance, depending on when you look at it. So I will follow up with them and we'll see what
Hey,
we
thank
can
you.
get.
Britt, should we really be using a blended index for them?
We believe you should. I think in terms of a policy benchmark, we have clients that might have in developed international markets might have core funds and not have a value and growth allocation. In this case, you have Silchester, who's your international value manager, and Artisan is your international growth manager. You can benchmark them to the EFA, but they were hired in 2014 to be your international growth manager. We believe that they are a growth manager. They're a little different than the benchmark, certainly, and are always going to struggle in extreme growth markets. But we think that it's a reasonable benchmark, and I think they are comfortable with being benchmarked to it. They wouldn't show it in their presentation if they weren't.
Yeah.
If we're saying international, does that mean non-US?
Yeah.
That's what's concerning me.
Right.
If they're making their money in US stocks, what it hides is, or what it could mask, is underperformance in what their core capability is supposed to be. And that's what I want to understand better.
Yep.
Understood.
By the way, another point is this: over the last 7 years, the market's growth has way outperformed value, right? Both in the United States and overseas. And even if you look at these indexes, the MSCI growth index over the last 7 years is up 8.15%. Value's up only 3.84%. So we're talking about the growth. We were looking for both growth and value, and the value side of our portfolio is outperformed the growth side. And I doubt there's very many funds that would say that their value side outperformed their growth side over a 7-year period.
Yeah.
I mean, I have obviously, I have concerns about their performance, but
Yeah, let's drill into what Rich is asking. I think it's a good thing to
Yeah.
look at.
Agreed.
anyways, if there's anything else, we can move on to ESG. Anybody else have any comments about Artisan or
No.
any questions? You want to go on then, Brett, anything else? And if not, we'll go on to the ESG discussion.
Sure, happy to.
Thank you.
So I sent around a number of ESG materials. I think the hope was to try and continue our discussion from last week. I wasn't planning to go through every slide in the deck that we sent over, but I'm happy to highlight any questions, talk about how we think you should approach considering ESG. So I really wanted to kind of open it up for a discussion to try and continue from last month and see where the board wanted to go.
One thing I'd like to get your thoughts on is, maybe have a little discussion about what evidence is out there that people that adhere to one another ESG objectives outperforms the general market. Is there any real evidence?
I think there's research papers on evidence that they think contributed to outperformance, and there's research papers on evidence that they think did not. I don't think there is consensus by any means on.
I don't think it's a performance thing, Jim. I think it's a political thing. I don't think it's got nothing to do at all with performance. Nothing, zero, zip, nada.
Mm-hmm.
It's all political.
Yeah, I mean, there are certainly aspects that I totally agree with Joe's point, but I would say there are other aspects with ESG that, like good governance, that's always been a part of, investment managers' philosophy or process when they're fundamentally looking at companies to invest. Having good governance is one of those things that I don't know why it needs to be associated with ESG. It's always been a part of the evaluation process and always been a part of, what makes a good corporation operate.
Yeah.
But, different clients implement ESG policies for different reasons. Some of them are certainly political. I would say that most of the big public pension funds promoting that they're divesting from Russia, I would argue that most of that is political because they can't. But if there are views from the board that whether it is motivated by performance or other reasons, and there are beliefs that we can develop or help develop or come to a consensus to consider, we're happy to go down that road. I think, it's a very controversial subject. Some people don't believe in it. Some people are passionate about it. And I think it's important for the board to come to a consensus with your thoughts so that we can proceed accordingly.
My view is that, one, I agree that if you look at who's doing all these proclamations about this or that ESG guidelines are going to fall, most of them are state treasurers who are politicians, waiting for the next office. My second question Britt answered was, is there a consensus of evidence one way or the other that funds perform or underperform whether based on their ESG approaches? And the answer I heard was there's no consensus. And my third point is, for defined benefit funds, I wouldn't presume to know what all our pension beneficiaries want us to do with their money in that respect, other than earn a good return. I think that's a pretty clear direction that we have from them. But whether they want us to avoid our firearms manufacturers, alcohol manufacturers, oil companies, we have no idea. And I don't think we should presume we do. I think it's a different matter when you look at the defined contribution. If we want to give somebody a choice there, that's something I would consider, but I'm skeptical of that too, because I think we'd probably get about $100,000 in it over 5 years.
One of the things is, and I appreciated that Brett sent the fiduciary responsibility as quickly as he did during the meeting last time, that, I requested that he send it out. And I do believe that our obligation is to perform as best we can with the investments we make. As far as, I think that it might not be unreasonable for us to, I don't disagree with the idea that there may not be a lot of funds put into some kind of option for defined contribution individuals to select money to go into an ESG type fund, but if we gave them the opportunity, I think that might be a reasonable thing to do. It would add one indexed fund, or however it would be. I don't know whether, Britt, you have any funds like that.
I think, hey, Frank, what you're referring to is nothing to do with the pension board. You're referring to the 403B and that aspect of it.
Right. Well, we don't advise people what to do, but we provide them with the options of what they select. So what I'm saying is, if we provided an option for them to select, I don't see how that would be. That is the board trying to help individuals who feel that it's an important in their investments, and we're not telling people to do it or not to do it. We're just simply giving them the opportunity to do it.
But we do have the obligation to pick a fund that has a good demonstrated track record, right? And Are there funds out there, Britt, that have demonstrated reasonably good performance in that area?
Yeah, I mean, as you can imagine, the proliferation of funds with ESG monikers has taken off.
They're all doing it. They're all doing it. Just put ESG at the end of the fund name and you're done. You're good.
And I think one of the hard parts, and I've had this discussion with another large corporate client, is if you do offer an option, and is that option a broad ESG option where there are passive global equity funds that essentially use like MSCI's ESG ratings, and they try to track MSCI's ESG Global Equity Index? Or are you offering an active environmental or carbon neutral fund? So it gets murky, where I think in a DC plan, a very broad ESG fund like a passive global equity option could make a lot of sense, where they use a third-party ESG rating system to essentially track and narrow down the highest scoring companies within that index. Could be a reasonable approach. But there are certainly a lot of different options and a lot of different avenues for the board to make that available to participants. So it really, performance, we can show you some sample performance from some ESG managers or ESG funds that we think are reasonable. We'd also want to conduct a structure analysis for the DC plans before adding any funds, just to show what the current options are, what the alternatives might look like, as well as document any ESG beliefs in the investment policy statement. And it could be something similar to what's in the pension plan IPS.
Is there anybody who feels that we should or should not, or, at least, investigate the possibility of having an ESG fund in the DC plan? Does that seem to be reasonable, at least to look at it as an option? I don't disagree with you, Joe, that it does seem that, I mean, when Exxon gets an ESG, rating, you kind of wonder, but
Well, there's like Brett was saying, it's a big area. I mean, ESG to somebody is the environment. ESG to somebody else is equity. Yeah. ESG to somebody else are sin stocks. Okay, so let's define. I mean, if you want to go down that road, I mean, how do you define it? How do you define it? What do you want to focus on? All three of those. Exxon gets very, very high marks through the ESG. When you look at the Standard & Poor's ratings of them, they get very, very high marks, A and B, very, very high, because they have diversity and equity on the board. I mean, so Exxon is based on that concept, it falls to that category, right?
Yeah, I think there's another risk we run. I don't have a problem looking into this a little bit. I think one of the concerns I would have is you offer a fund, and then people start, well, how about one that does this or one that does that? And then you're on a slippery slope here. Brett, I don't know if boards have ever polled the investors to see if they have an interest, and just have people vote somehow, and we're going to pick the fund that gets the most votes wins. Yeah, I don't know.
Yeah,
I don't think that that's a good idea, because we are the ones who make decisions as to what. That's the decision the board makes. This isn't a democracy. This is a board that has. We are all here because I believe, because there's an expertise in everyone here and an understanding of economics and finance and investing. And I don't think that we go to a group that doesn't have that
No,
qualification.
I think you're misunderstanding me, Frank. What I'm saying, we could pick several, I'm not saying it's a good idea either. I'm just saying it's an option. We could pick several ESG funds that have different slants, as Joe pointed out. One's focused on environmental stuff, another's focused on whatever. And they're all good funds, but they have a different focus in the ESG world. And we tell people, we're going to offer one of these, only one of these, and you all can vote. They're all decent funds. They all meet our fiduciary obligations. They just have a different orientation in terms of their focus on ESG.
I think we're opening up a can of worms.
I agree. I totally agree.
I think we're going down a road that, you know, our job as a fiduciary is to, you know, you read the duty of loyalty, a duty of diversity, duty of care, duty to follow the plan documents. We're doing what we should be doing. For us to decide what's ESG, what's not ESG, what's this, what, you know, yes, everybody wants clean air. Everybody wants clean water. Everybody wants equal opportunity. Everybody wants this. I mean, this is not, we don't need to, you know, change what we're doing. I mean, maybe we make a statement. This is what we want. And if something is glaring and some company or some manager is really bad, then we'll do something. But other than that, you know, to try and change what we're doing to meet some political, the way the wind's blowing, you know.
Let me just say this. I don't think we're trying to change what we're doing, because we invest, the funds that we invest, that we make decisions on where that money goes. We have not at all, I don't think, said that we're going to adjust it according to an ESG. All I'm suggesting and asking the board is if they think that it would be reasonable for us to say we'll have a selection, just like people don't, you know, we invest money in I had a discussion, and one of the things is, look, we have money at Silchester. Well, they have money in Israel. Some people might be opposed to that. We're not influenced by that at all. All we're saying is, and if we do select an ESG and people don't feel it's perfect, you know, we're not perfect either. So we'll do the best we can. And if it's one that people don't like, so be it. I mean, I wouldn't even go there, Frank. I wouldn't even go there.
What would be the effect if we offered choices to people? If we offered one additional ESG fund, if we offered 3 additional ESG fund, does that cost more? Are the fees greater, or is it just give a broader choice?
So I would say 2 things. One is if you were going to go down this avenue, we would say 1 fund. Adding more funds and more choice is not necessarily good for participants. The average participant can not distinguish, you know, large cap equity from small cap equity.
Look where the money's going now.
No, I understand that, but it is your concern because you're worried. You're doing your best for participant outcomes to meet their retirement needs.
It's not our job to decide that, well, wait a minute, these people can't make that decision or they're not sophisticated enough. Our job is to offer choices. And if there are different ways to satisfy ESG without any additional cost or without any additional difficulty in monitoring it, why not?
So I would say there's one other option, and if you can certainly add a dedicated ESG option, and we can explore going down that road. Another option that many clients do, instead of offering a dedicated ESG option, is they have a brokerage or a mutual fund window in the DC plans that is available to participants. And essentially what this does is they can actively go into this, call it a mutual fund window, and purchase any mutual fund that's pretty much on the market. That includes ESG funds, that includes carbon funds, you name it. And what we could do is have Empower come in. We need to have them in this spring to do a review of their administrative services. We could ask them to discuss the mutual fund window option, which essentially would give participants the ability to go out in the market in their DC plan and buy an ESG fund, buy an environmentally friendly fund, buy you name it, so that they have access to it, but the board is not making a statement with a specific option or belief associated with that fund.
That sounds pretty reasonable. Is there any additional cost for?
I don't know.
making
I
that
don't
up?
know. So we'd have to ask
Yeah.
Empower and
Yeah,
have
that would
them.
be, to me, that's the major question, because if there's an additional cost, we want to limit it. If there's no additional cost, if there's no additional monitoring that you'd have to do or we'd have to do, why not?
We don't want any additional cost to the participants, the
That's right,
individual
yeah.
if there's an additional cost to the person who wants to do that, so be it, but we don't want other people to subsidize that cost.
Yeah.
And
I
that,
agree
that's
with that.
exactly what the cost would be, Joe. So if a participant went in and elected to use this,
That's fine.
they would be charged a fee, but it would not have any bearing on other
And then-
participants. And we would not monitor anything going on in that mutual fund window. Whatever's done in there is outside of your purview.
That might be a smart way to address it.
Well, and I
What-
think there might be other participants in the DC plan that want a self-directed option anyway. Forget about the ESG. They just might want to have their own place to put their play money. That's fine.
Well, the one thing though, that we used to have a number of options for people to put money in. And if you remember, there were sometimes funds that had like $25 in them, $50 in them. And I think that, like the idea of the buffet theory is that there's so many selections, people don't know exactly what to pick. I think that it's reasonable for us to possibly find a single fund. If people don't find it's perfect, I don't want to open a window up where somebody says, I only want to own small bond fund companies. I only want to buy triple B bonds. I only want to buy longer dated bonds. I only want to buy bonds from whatever. So, you can break down any kind of, look, how many hundreds of different kinds of index funds are there now? There's hundreds and hundreds, probably thousands now. We don't want, I don't believe it would be in our best interest for somebody to come in and say, I want to be in a fund that invests in Bitcoins or ETFs or in wind power or anything. I think that's going to, when Joe used the phrase, it could be a slippery slope. We're trying to provide a selection for a person or individuals if they care deeply about the environment, but we still have a fiduciary responsibility to do the best we can as a group. And that's just how I feel. And remember, of all the money in those funds, over 90%, I believe, is in dated funds. So it isn't like, so if you look at it, if there's $45 million there, 90% of it is in dated funds, we're not talking about so much money that what are we going to do? Have 5 funds and somebody's going to put $100 in each one of them? We can't do, I don't think that's just not reasonable.
So,
I believe.
Frank or Brett, correct me if I'm wrong here, just in terms of, so I think we've agreed, nobody wants to go down this path with the defined benefit funds. Is that correct? Or
Oh, yeah,
is that not-
I think that, I believe the consensus of the board
Yeah.
is because of we have a fiduciary responsibility,
Yep.
and that's our primary. And in fact, I believe the last time when we reviewed the policy statement, one of the things that I requested that we made an alteration so that we didn't have to, we can listen to the public, but they don't have input into what decisions we make.
Right, so we have a high degree of fiduciary responsibility for the defined benefit programs. I think we have some degree of fiduciary responsibility for the DC plans for the funds that we put in it. monitoring
with
their
that.
fees, monitoring their performance, et cetera. But with a directed brokerage channel, I don't think we have any fiduciary responsibility other than to make sure it's, they've got good plumbing in place perhaps, but other than that, nothing. And if we, and when you look at all the ESG options that are available, and the fact that somebody might want self-directed brokerage for other reasons, I think the way to solve this, if we do anything, I'd be happy doing nothing, and I'd be okay doing a directed brokerage option. I get uncomfortable when we start picking which ESG fund we want to put into the DC plan general options, because then I just think that's a slippery slope. And if somebody wants to do it, go the directed brokerage. You can do other stuff there if you want, and invest in gold ETFs or whatever. That's fine, and you can do ESG there if you want.
Rick, can I ask a question? Can you set up a fund where there's like a minimum amount? I mean, you can't put $25 into the fund.
Well, I think in terms of what the board would monitor if we went down that avenue, and we certainly would want to do a lot more research and discussion before ever going there. All you would see in the DC performance report is a line item under the asset distribution that says self-directed brokerage window. And there would be an asset number there, and that's it. So if a participant went in and put $5 in 100 funds, you would not know. And it's not your job to monitor the funds that they invested in through the brokerage window.
And if the other participants aren't paying any of the fee, we don't care either. Right?
Let's hear more about that option when Empower comes in.
Right, but I do think that
all right.
then does somebody say that they want to use a brokerage firm to do? Why can they only do it in ESG funds?
No, they can do anything.
And that's
do
why
anything.
I'm
wanna buy-
concerned. Right, but that changes the whole structure of Empower. Then, to me, it would, anyways. And so, I guess what I'm thinking, and I'm not saying this is what we should do, but if you listed 2 or 3 ESG funds, and after a year, and have a minimum of, say, $500 that you have to put in, so nobody puts in $25 in 3 of them, and at the end of it, if these funds don't have, if they have a very small amount of money in them, then we decide to close them down.
Correct.
So I can tell you, Frank, just from an uptick standpoint, I work with one of the largest corporate DC plans in the country. They added a dedicated ESG option about 3 years ago. And I think the current allocation is about 0.1%.
Correct me if I'm wrong. This discussion that we're having tonight didn't start because an employee or a beneficiary or whoever raised it. This discussion started because a politician raised it. Am I correct in that? Or did someone who's participating with their money in these plans come to us to have this discussion?
The person, 2 people on the city council.
Need I say anything more? Need I say anything more?
But wait.
Do they have money in the plan? Do they have money in the plan? No.
Joe, you asked a question. Give me the opportunity to answer it, please. They represent people, and they said that their constituents were concerned, wondered about it. So they were the spokesperson for somebody who has money in the plan. So we're responding to
so the constituent is someone who voted for them. Was the constituent an employee of the city?
Excuse me. We do not know that the constituent voted for them because we don't know who people vote for. All I know is that if someone on the city council, someone in the plan questioned them about it. And so that person came to me because I chair the board. So I don't think that it's, that,
So-
you know, do you,
Okay,
I am sure that if you want, we can find somebody in the plan to come forward, go to a meeting, be part of the public comments and say, I want an ESG plan.
where
I don't
are
want-
they?
What,
Let them come.
you know what? I believe that one of the things that I have always tried to do, and I believe it's valuable, is for us to not be in the press, not to be in the public. I don't think it's a negative that we don't have a situation where 40 people come in and want to talk for 3 minutes to talk about ESG funds. And I'm sure that if you got somebody rallied up to do it, they would probably find their friends to come out and talk about it. I think it's simply that a person came, and that's why we're discussing it. Personally, if we don't do an ESG fund, that's fine with me. I'm just saying that, you know, and I don't think the consensus of the board is to really move ahead aggressively to do it. But at least that, you know, it's a situation that came up, and, you know, look, I mean, if the mayor came and said it, the mayor's not in the pension plan now because he's in the defined. So what would you do? Should I say to the mayor, no, I'm not listening to you? Am I supposed to say to somebody in the city council, no, I don't care what you say? Of course not. So I'm trying to do the best I can with this. And believe me, there's been a lot of time I've spent not in these meetings talking to a lot of people about this, trying to do the best I can for us to move forward with it, to satisfy some people who are concerned. I think that Britt could probably tell us that this is not a unique situation, that there are probably other funds that are doing the same thing, that are looking this over. And my suggestion earlier about having a couple of funds to say, have a minimum amount that you got to put into it. If people don't put money into it after a year, if there's under $1,000 or $5,000, whatever benchmark we have, then we eliminate the fund. That's all. We say, look, we tried to show this to individuals. They clearly demonstrated that they weren't as concerned about it. And so we moved on and closed the fund down, because that was the difficulty we had. Remember, when we got into the defined contribution plan, we didn't really have the opportunity to select the funds. And we had, 60, 80 funds, and it was awful. And I don't want that. You know, just, I was looking for a possibility to satisfy some people who are concerned about the environment or whatever. And then, but also have a way to keep the number of funds that we have limited.
Well, I want to go on record, Frank. I am very concerned about the environment. I am very concerned about equal opportunity, but I'm going to sit on this board and I'm going to invest the best way I can to get the best returns for the people. And I'm not going to limit my scope. Corporate America understands what's going on. They are kowtowing to the whole concept. They all are. My firm, everybody is. So, you know, they're all going to have the stamp. We're ESG compliant. So I'm going to sit here and I'm going to do the best job I can, not limiting myself to, you know, but the board wants to do something as a board, then we could vote on it. We can go down that path, but you know.
I don't disagree with anything you said. Our fiduciary responsibility in the contribution part of the plan is we're fiduciaries and we look to invest as best we can. We're not, the difference is in the defined contribution plan, we don't have a fiduciary responsibility there except to select some funds. We don't tell people where to put their money. We are just simply really overseers of that plan. We're trying to keep, I believe it's important for us to keep the plan in a reasonably sized, you know, for limited selections. And also, I'm not, if we don't have an ESG option, that's fine too. That would be a decision the board made. And it would be on the public record. You know, people can go on the city's website. They can read the minutes of this meeting, which is fine with me. And if we choose not to have an ESG option, that's fine.
Hey,
I-
Frank, what would you have a concern with letting people select ESG funds through a self-directed brokerage window?
The only thing that a self-directed window, my concern is if you do it for ESG, are you going to also do it for small caps? Are you also going to do it?
Self-directed
I'm-
means they can pick whatever they want.
I understand what self-directed means. Okay. And what I'm saying is if you open a window because somebody wants to be in ESG funds, are we going to open a window up because I want to be in funds that make left-handed widgets? I
It's the
want to
same.
be that what I'm saying is once you open a window up, then that changes the empower and the way we have right now. To me, that would be a radical change in the way we have the defined contribution plan.
Frank,
it's a
there's only one window. You can go through that window and buy ESG, you can buy gold ETFs, you can buy whatever you want. It's one window.
I understand it's one window. And what I'm saying is by opening that window, then why do we go through anything about looking at what funds we have? Why would we go through selecting funds? And one of the things we do is we're supposed to oversee at least these funds,
Mhm.
right? As a fiduciary, we at least look over the funds,
Yep.
right? We review what the funds are doing. If they open a window and people put their money into those funds, could we later on be liable because we go, what are we going to do? If there's 200 funds, 300 funds, what are we going to do? Are we going to study all those funds and see if those funds are proper?
No, I
there's a
think the
dis-
beauty of having a self-directed brokerage window is we have no fiduciary responsibility. Am I correct on that, Brett?
Yeah, essentially, and we can get the details from Empower, but there would be a number of disclaimers before they were ever able to open their account in the brokerage window and make any selections. And the board would have no responsibility in terms of monitoring what people are buying in that window. But at the same time, to Frank's point, while you are giving people an option for ESG, you're also potentially giving participants an option to buy something that they have no business owning in their retirement plan whatsoever. And I don't know that it's your responsibility either way, but it is something certainly to consider.
Right. Ultimately, you know what? This thing's called lawsuits, right? And there's plenty of lawsuits and there's plenty of pension plans being sued. And the broader selection and the less control we have of what people can do with their money, I believe, increases the potential for us to be liable. And I don't want at all to have any liability. I'd never want to be in court because of this board.
Do we have
I think the liability balance comes down. Do we have more liability by hand-picking for people an ESG fund that underperforms basic other indices? Or do we have more liability by giving them a self-directed window that has all sorts of disclaimers up front and they pick a bad investment? I'm not sure that there's a clear answer to that.
Well, there may not be, but that's a good thing to say, because since you said there may not be a clear answer, and that's where litigation comes in. And I don't want to be in a place that doesn't have a clear answer. I want this fund to have as many clear answers and as few possibilities of uncertainties as we can get. So to me, if we limit it to only one ESG fund, or even if we decide not to have an ESG fund, which to me, I would say that at least of the five of us, two, I would say you and Joe are not in favor of having an ESG fund if we did it without a window. I don't know where I stand, and I don't know where Charlie stands or Rich stands. But right now, I'd say it's at least two people who seem like they're not thrilled with the idea.
Yeah, I just think we're putting ourselves on a slippery slope to offer one. And again, it's people
Okay, I
going
have
to
a
compare the
question.
performance.
We don't offer one now, so.
Hey,
are we not on this-
Frank, if we wait a little while, dollars to donuts, there's gonna be an ESG stamp on the back of a couple of the funds that we have already in the plan.
There may be, I mean,
there's,
look, we're having a discussion. We don't need to make a decision tonight. We don't even need to, we have, we have time. And I'm not pushing to do this. I did speak to people and say, listen, we still have, our primary objective is to be fiduciaries. And that's what we are. And that's what, I don't want to go on a slippery slope. And I do think that a window could be, to me, that's even more so. I mean, somebody invests in a Russian fund and the next thing you know, they're suing us because we should have known better not to let them buy it. I don't want that. I want people to know what they're investing in. I do agree with what Joe says, that to me, it's politically motivated, the ESG, but we're having the discussion. And it's not right now a decision we have to make. And I'm not at all, if somebody even wants to propose that we don't follow this, that could be fine too,
So Britt, we're having Empower in a couple months, you said?
So I think next month, there's a pension and DC meeting. I believe the actuary is supposed to present.
Right.
At the pension meeting. We could invite Empower to give a brief presentation during the DC meeting if you'd like.
I'd be interested in hearing from Empower of all the DC programs that they're involved with. What percent of the assets are going into what percent of those programs have a directed brokerage option? And what percent of the assets for those programs are using the directed brokerage window? And then also, what, if any, liabilities, legal lawsuits have been involved around self-directed brokerage windows? If that's a real issue or not,
well, I mean, maybe, why don't I? So I don't want the April meeting. I mean, if the actuary is coming in, it probably doesn't make sense to have Empower in, but we can at least request information from them. We can distribute it to the board. We can discuss it during the DC meeting. And to Frank's point, I mean, this is not something that needs to happen tonight or tomorrow. And the fact that we're having these discussions is good. It's good to know where people stand. It's good to know what the board's beliefs are. And we can continue the discussion at the April meeting during the DC meeting, since it seems very clear that with the pension and OPEB implementing anything differently than the board has been is not on the table, which is certainly reasonable. And we can continue the discussion during the DC meetings and, go from there. I think that's a reasonable approach. And when we do have Empower in to present, we can ask them to provide some participant and industry statistics. We certainly have some in our ESG survey that was in the education materials that we provided, and we can continue the discussion. I think it's going to be ongoing, and there's certainly no need to make a decision tonight, next month, or anything like that. We'll get more information and go from there.
I do think that we've had a discussion 2 meetings in a row, and I don't think it needs to be on the agenda every month. So I would prefer not to discuss it next month.
Yep.
Understood.
Do you recall we discussed directed brokerage with Empower when we were picking them? What was do you recall the discussion why we didn't do it?
I
Frank, do
I
you?
thought it was because it was just, I mean, think about it. If we did do that, why would we have any selections at all right now?
Well, I
Just
think
say to everybody-
some people want us to pick their funds, but there's a group that probably would prefer to do it themselves. I don't remember if Empower has a financial incentive to push directed brokerage for their own fees. And if so, I think that might have been what sort of scared us off a little bit.
There's definitely more fees, and I think managed accounts was an area
Right.
that was fee driven. I can send the board some self-directed brokerage prevalence and certainly some statistics around what other plans are doing. Let me ask Empower. I mean, the worst thing that happens is they send us some information for us to read and review, and whether there's anything that comes of it, it's really irrelevant. So at least we can ask Empower. We can send you some statistics that we have on both individual ESG options as well as the brokerage window or mutual fund window, and just go from there. And
Right.
Frank will leave this all for April and plan to discuss it at the following DC meeting after that, which I think is in the fall.
Right. That, I think that's the best way to do it. So this is going to be basically, we've had a discussion, and this would be the next DC meeting. The actuaries have already been pushed back, so that it's not fair to them to just keep bumping them back. We have the actuaries in April, and that's when we have the DC plan. The next DC plan isn't until the fall, and I think that we could just wait until the next DC plan to discuss this. During that time, I think that Britt, you had mentioned how one of the large funds you have had an ESG fund for a long period of time, and they have very, very little money in that fund. And there may be, to Joe's question about who approached, there might be one or two people, and there might be people that there may not be as much interest as we're giving all the time and energy to this situation. So
Frank, to close on from a board point of view, I think that I could speak for myself, but I think I could speak for others that we are well aware of what's important to us, our children and our grandchildren. We all want what's best in the big scheme of things. And we will watch for and be on the lookout for glaring or deviance that deviates from that philosophy as we look at our money managers and as we interview and monitor our managers. And if something comes up, we'll make a change.
Joe, I agree with you. And one of the concerns I have is I don't want to have a lot of, there's a board, it can be, we have terms and we can be replaced. If there was an outcry of what our performance was, what our selection is. And I don't want to be in a situation where down the road, people are deciding how we invest, because we take on the liability and we should be taking on exclusively the decisions. And I think that, like I said, Silchester has 0.5% of money in Israel. There are people who don't think we should invest in Israel. There's the S&P 500 has Philip Morris in it. They don't think we should invest in tobacco companies. So we could end up putting in T-bills, and then somebody would complain that, we started an illegal war, so we should invest in the United States. So then what are we going to do? So what I'd like to do is just continue to do what we do. We look for sound managers. We listen to our consultants, and we move forward as best we can. And that's all I expect the board to do.
And we'll be on the lookout for something that comes up. And
I would say, Frank, that a lot of the investment managers in the pension, OPEB, and DC plans take ESG factors into consideration in their investment process. So this is going on, whether it's a dedicated ESG option or not. And I think it's important to tell people that are asking for this that is going on. And if you would like us to survey all of the managers to understand their internal ESG factors and policies that are embedded in these funds, we are happy to do it to provide a summary to the board.
As a matter of fact, Artesian had a section on it in their presentation. They just,
I would be surprised if you pulled them and one of them said, "We don't care." That would be that would really
I agree.
So anyways, why don't we move on to performance review? Unless hopefully no need to discuss it any further. Okay.
No.
Performance.
All right, I think Joe's getting antsy over there. It's 8:11.
What time is it, Frank? Oh shit!
Oh my God, it's 11 after.
Oh my God, Frank!
Should I tender my resignation?
You're slipping, Frank.
Believe me, I don't like this ESG stuff really that much more.
Go back to the constituents and tell them that we ran over because of the heavy discussions we were having about it, Frank.
Frank, we're happy. We're happy you sit between us and the Common Council.
Oh, it's a joy.
That's why Frank gets paid the big bucks.
That's exactly right.
All right.
Okay.
I'm gonna in the interest of time, I'm going to run through the January flash report. In my email, I also sent the full performance reports and full executive summary.
Why don't we just do the flash, right?
Yep, we're just going to do and as of end of January, on page 3, you can see assets are about 527.2 million. Obviously markets in 2022 have been extremely volatile with the onset of inflation, obviously Russia and Ukrainian war, which has really caused equities to certainly detract. In terms of asset allocation, you can see there continues to be a slight underweight to total equity, mainly driven by US equity at just under 33% versus a 35% target. Slight overweight to private equity and real assets, and slight underweight to domestic fixed income. On page 4, in terms of performance, fiscal year to date, within US equity, both of your US equity managers, LSV and Columbus Circle, have done extremely well on a relative basis. LSV up over 7% versus their benchmark, as we've seen value come back into favor. So good to see them after struggling in the market environment over the last 3 to 5 years. And Columbus Circle continues to do very well. They had a very strong fourth quarter. And you can see their performance over time. I did send the board a note on Columbus Circle following another due diligence meeting that Callan had. While they are certainly some concentration of client base, I think Principal has invested a significant amount within the team and the funds, and we're comfortable keeping Columbus Circle moving forward. We'll certainly monitor any changes with a little more heightened awareness, but I did want to highlight that and make sure the board was comfortable given some of the changes there. Within international equity, we heard from Artisan. You can see they've month of January up over 4.5% versus the growth index. Really propelled them. You can see their track record's looking a little better. Fiscal year to date up about 3% over the benchmark and about 1.7% over the trailing 12 months. Silchester had an extremely good February, up over, I think, at least over 1% versus the benchmark. Long term, they continue to be very good. BlackRock, slightly negative. They did have some exposure to Russia, which will play out, but wanted to make you aware there. You can see your global equity long short managers. Blackstone, biggest detraction there is some of their exposures within emerging market equities. Last page, just in terms of fixed income, you can see in a rising rate environment, we've had negative real returns here for the fixed income managers. They are doing fine versus their benchmark. UBS has done extremely well fiscal year to date, really trying to produce a positive return in any market environment, which is good. They're really going to be a ballast in a very volatile markets as we expect these to continue. And finally, PIMCO did well, about 1% for the fiscal year. I think they did have some Russian exposure as well, both on the equity side and the debt side. Not a lot, about 1% of their portfolio, which again is a wait and see approach at this point with all the markets being closed. Total fund, really strong performance over the year and longer terms, and really no concerns overall with the managers.
Any questions? Perfect. Okay, next, cash needs. Chitsame, are you there? Hello.
Still here. I'm still awake. Okay, our current cash balance at the beginning of this month is 7.3 million. We have pension benefit payments next week of 3 million. So at the end of this month, we'll be around 4.5 million in cash. So I would like to request 6 million of cash to get us through the next 3 months.
Excellent. Rick, do you have any?
I'm going to share my screen, Frank, just so everyone can.
Great.
Everybody see that okay?
Yeah.
Yep.
So given the current positioning, we're underweight equities, a little over 2%. International equity, just a slight underweight. I know we had Artisan in here today, and there's been some discussion of using them as a possible source for redemptions, which we are comfortable with. And then the only other overweights that you have that are liquid is really PIMCO. You're overweight about 1.8%. So with a $3 million redemption, bringing it down slightly, but we think it's a reasonable place to trim from. I think we might want to consider redeeming slightly from UBS if there's any desire. It'll take about 6 months to get the cash. I think it's 90 days notice with quarterly liquidity. But again, in a volatile market, your absolute return manager is one that's really going to help be a ballast to the portfolio. So happy to entertain questions or further discussion.
Brett, how much different do you think this looks now than it did the end of January with the markets in February, early March?
Yeah, let me, so February S&P was down about 3%. Month to date, it is down another 4.6%.
Yeah.
So I would say that your equities are probably further underweight than they are in this.
Yeah.
One of the things that I think last time they requested money, I even suggested that maybe we leave PIMCO off. And it does seem like there does seem to be inflation and commodity pressures. And one of their 3 segments, if I'm correct, is to be like basically in inflation driven items. And I think that right now, that's kind of a place to be. That was my, suggestion that we leave PIMCO alone. But, whatever ultimately, Artisan to me, has like I said, growth for them being growth, and growth is now becoming less popular. And while it was popular, they underperformed badly. No,
And Frank, we're comfortable if you don't want to withdraw assets from PIMCO. I think this is more of looking at your liquid asset classes and where you're overweight than trying to make a tactical decision. I think we agree with the inflationary pressures and the commodities outlook. So can totally understand and support not withdrawing funds from them. I think if you wanted to go elsewhere, we would suggest BlackRock,
The emerging markets or the index?
the Russell 1000 index.
whatever, I mean, I'm not. I
Yeah,
was hoping, Rich, what do others think?
I mean, if you look at what's happened the last 6 weeks, since this was done, we're probably below 30% on US equities, right? I don't know, it just seems like, selling on the dip.
Well, based on everything I've heard, I wouldn't have a problem with taking the whole 6 from Artisan.
I'm with you, Charlie.
All right, I move that we take 6 million from Artisan to fund
I
the
second it.
pension needs.
I second it.
Okay, we have a motion to take the 6 million from Artisan. It's any discussion, further discussion? All in favor?
Aye.
Aye.
Opposed?
Good.
I didn't hear 5 ayes, but I didn't hear any opposed, so thank you.
Okay.
Okay, 6 million from Artisan. Okay, the one other thing is that, what is it, BlackRock, you need 90 days advance? Was it,
Yes.
was it? I mean,
Blackstone, ABS, and UBS all have longer withdrawal periods. So essentially, it depends on which manager, but it would be roughly 6 months until you got the cash. I don't think at this point you need to submit a redemption request. Maybe next month we can look at the UBS allocation, given where equity markets have gone, and see if that allocation is further overweight. And assuming it is, then we can discuss a future withdrawal.
Did we at a past meeting ask for liquidity from one of our quarterly ones?
We got a redemption last year from Blackstone. I think it hit in the fall. Of
The long
2020.
short,
Yep,
but nothing more recent.
correct.
Okay.
Hitsame, if I could ask, you said that it was roughly $3 million that you were paying. Is
Yes.
is that going to be an ongoing number now? Is it increased that much?
I know we started at 2.7 million. I did notice that last month's pension benefit was around 3.2 million. But I would say it still would be around 3 million going forward.
Are there seasonal patterns to retirements? Just maybe we get more in the first quarter, people looking forward to summer, or?
The only thing that I notice the fluctuation is with the drop plan. Some people, once they meet their 5-year, they would cash out their drop plan, and that could be relatively large. It's like $100,000 or $200,000.
Okay.
But we should be maybe anticipating this number is not going to be going down. We could be anticipating, say, a 9 million every 3 months soon. Except there'll be the one cycle would be the city's contribution.
Correct. So there's the city's contribution and the employees' contribution too.
Right. Well, I was thinking that you had mentioned 3.2, but then you said 3 because I figured there was the contribution from the right now the current employees. That's the 200,000.
Yes.
But that's pretty steady, and the 3.2 is pretty steady.
Yeah, I would say so.
Okay. Anything else? And if not, is there a motion to adjourn?
Move to adjourn.
Second.
Second.
All in favor? Aye. Joe's barely awake. Okay.
I'm
quickly.
awake, Frank.
Uh,
I'm good. I'm good.
all Fired up.
I'm hungry.
I haven't had supper yet either.
I'm hungry, but I'm good.
Okay. Anyways, OPEB, I want to call the meeting to order. Approval of the minutes that were very short. Do I have a motion to accept the minutes?
So moved.
Second. Joe, did you say
Second.
second? Good. All in
Second.
favor? Aye.
Aye.
Aye. Is there any public comment? No public comment. Excellent. Performance. Britt.
Great. I will get through this as quickly as I can for you. So 136.9 million at the end of January. Equities slight overweight, 68.7% versus 68% target. Slight underweights to international and fixed income. Performance on page 4. You can see your index funds continue to track their benchmarks adequately. Some fair value pricing in the international fund, which smooths out over time. And your fixed income managers and PIMCO have done well relative to their indices. Overall, strong performance, again, for the year and longer time periods. So no concerns with the OPEB.
Any questions regarding the OPEB?
Move to adjourn.
Second.
All in favor?
Aye.
Opposed? Opposed? No. Motion passes unanimously. Thank you very much.
Thanks, everyone.
Night all.
Still-
Have a good night.
Good night, everybody.
Okay, we're over, everybody, 27 minutes.
All right.
We're gonna dock your pay, Frank. We're gonna dock your pay. Good night, everybody. Thank you.
Good
Good night.